This is the Rocket City Retirement Show with Cris Wallace. Cris loves educating people in person and over the airwaves. Whether it's retirement planning, investing, tax, or legacy, Cris prides himself in helping protect what matters to you. This is the Rocket City Retirement Show.
Hi, I'm Luann Fulmer, and welcome to the Rocket City Retirement Show. I'm here with certified financial planner and financial advisor Cris Wallace. He's president at WG Financial Group. Also joining us, Graham Bauer, financial advisor, and Richard Constantine, a certified financial planner and financial advisor. So all here today to advise you on retirement planning. We have a really good show for you. I can't wait for us to get started. Here's the way to reach out to Cris and get a complimentary discovery visit, 256-937-2010. Again, you can call. You can also text the word visit. I want to mention that. Just text the word visit to this number if you prefer texting. 256-937-2010. Get on their calendar. Check us out on Facebook at WG Financial Group 256. Remember, our motto is plan, retire, play. We'll be talking about that all throughout our show. And find us online anytime at WGFinancialGroup.com. And remember, this show is available on Spotify and Apple Podcasts. Anywhere you get your podcast, Rocket City Retirement Show is what you look for. So, gosh, welcome to you guys. I'll say hello to you, Cris, first.
We are all back this week. We got the gang back.
Yeah. Hello to you, Graham.
Hey, Luann, how are you?
I'm doing great. And Richard.
It's good to be back, Luann.
Man, a lot of stuff's been going on since we've all gotten back together today. We've had a lot happening. Oh my gosh, the Olympics are over now, so we won't be talking about that much anymore. But what we are going to talk about right now is some WG positivity. We like to get to that right off the top of our show. Graham, what do you have for us today?
Yeah, so today I saw this article, and I thought this was kind of cool and a little bit relevant for some of the things we've talked about recently. Because I know one of the topics that we talked about on a previous show is kind of comparing, retirement to a mountain and, being your pre-retirement years, going up the mountain. And then once you're retired, kind of trying to go down the mountain, and how it's actually statistically more dangerous to go down a mountain than up. And I think we used a conversation about Mount Everest to kind of talk about this. And our story today actually comes from Mount Everest. So I thought it was kind of on brand from that perspective.
Right.
So there is this new technology that's coming from China, I believe, to basically the Sherpas straight into the people who are working day to day on Mount Everest, where they have started sending them these drones to clear trash on the mountain instead of them doing it on foot. So one of the problems they've been facing when climbing Mount Everest recently is obviously there's a ton of people doing it, more people than ever. It's become a lot more accessible. And with that, there becomes a lot more trash because, people can't necessarily carry all of the stuff up and down with them that they bring.
Yeah.
So they expect that people will have to leave some trash on the mountain. And right now, it's just the job of the Sherpas that go up with them to kind of collect trash as they come down the mountain. And that's proven to be more dangerous because they have to carry a lot more weight because of that, which causes them to use more oxygen. And there's been a lot more deaths because of that. So they've been using these drones basically to supplement that, where they basically have been flying these drones around up there, picking up the trash and bringing it down, which ideally will save some lives, for people going up and down the mountain, not having to bring everything with them, but still keeping the environment up there as clean as possible with the tourism. So I thought it was kind of cool, kind of on brand with what we've been talking about. And yeah, just kind of interesting technology.
Yeah, put those drones to work, may as well. Easier on them than on the human body trying to come down. But
so you said people are leaving a lot of trash on their way up and on their way down.
Yeah, because I guess, you just kind of have to eat and stuff on your way up and down, and your oxygen starts to run low and you just can't carry as much weight. So
yeah, I'd leave about 195 pounds of trash on the side of that mountain if I tried to go up.
From your snacks.
That would be my body. I wouldn't make it all the way up. Probably wouldn't make it all the way down.
We're going to
either.
need a bigger drone. Guys.
That's right. We're going to need about 3 or 4 drones. Like trying to pull King Kong.
Could you imagine your job being to fly the drones that navigate Everest?
Fun.
Where are you? I wonder. From where? Are you at the bottom, or you have to climb too?
I think from the base camps. So kind of you're like somewhat up the mountain. But from what it sounds like the Sherpas are going to be the ones piloting the drones, which is a very futuristic thought because when you think of the Sherpas, they're kind of a more rural and like agrarian society. So the thought of them just like piloting drones on Mount Everest does sound very, very futuristic. But
it does.
I guess the future is now.
It is now.
It is.
All right. And speaking of now, it is time for our market report. We always turn to Richard for that. What do you have for us?
Well,
today?
First of all, before he gets started on that, I want to interrupt. And he took the market with him on vacation last week. And he brought it back this week. So welcome back. That's what I texted him over the weekend.
That's funny.
I wish I could claim that I was the cause of the market being down. I realize I don't have nearly that much power, though. We'll leave that to the Bank of Japan and a few things that were going on with them. That's really why the market was down so significantly last week without getting really into the weeds.
Mm-hmm.
But still, year to date, we are still seeing double-digit returns both in the S&P 500 and in the NASDAQ. And this is one of the reasons why we always encourage our clients to, zoom out and stick with your plan. Mm-hmm. Because if you had panic sold last Monday, you've lost out on about 6% in returns. So year to date, the S&P 500 is up 13.52%. The Dow Jones is up 5.24%. The NASDAQ is up 14.56%. And the aggregate bond index is also up 1.52%.
Look out. The bonds are positive.
They are. And, as you and I've talked, I mean, we expect this trend to continue, especially if these rate cuts are actually going to be put in play in September, like the Fed has been talking about.
Mm-hmm. I don't know if you looked at the futures market today, but I check it every day. And over the weekend, it kind of balanced out. I think I published some information on our Facebook page, but it was kind of a 50-50 chance on whether or not they were going to do 25 basis points or 50. As of this morning, and you'll talk about this, I'm sure, here in a minute, Richard, but the PPI data that came out, it actually went up to like 55% now. It's leaning back towards the 50 basis point rate cut. So it's kind of interesting to keep an eye on that.
It is. I mean, I think, because the PPI numbers that came out, they were showing the trend of inflation slowing down, which is why the Fed increased the rates to begin with. And so, what this is showing is that they do have the ability to start lowering rates and get back to that normalized rate of around 2.5% that the Fed has stated that they want to maintain. So it's encouraging that, although painful in some ways, that their actions have started to pay off in a more meaningful way.
Yeah, PPI numbers I think came in, pretty far under target, or not target, but pretty far under expected. So, we're doing the show before CPI gets released. I have to imagine that if CPI comes in under expectations as well, you're going to start definitely seeing that 50 basis point rate hike. It wouldn't surprise me if the futures market started like dipping over into the 75 range at this point. But, if it comes in low, you can expect that 50% basis point cut in September. As far as the interest rate outlook, Richard, I know we were watching the 10-year Treasury, and over the past couple of weeks, I mean, it's fallen off more than 60 basis points. I believe a couple of weeks ago, it fell 60 basis points inside of 1 week. And that was basically the market pricing in some of these rate cuts. It got really aggressive on that Monday where the market was off, as much as it was, where there was a massive drop due to what was going on in Japan, as you mentioned. So it's definitely going to be an interesting outlook as we continue to progress here late in the year. Election coming up, rate cuts potential. It's going to be interesting to see what happens.
It really is. And the Fed always, alludes to the fact that they try to stay out of politics regarding which way to lean, depending on who's in office. But I think everyone listening knows that they might say that, but we can't promise that.
You can check their donation history and you can tell which way they lean just like that. It's a quick, easy way to talk about it.
Exactly. So but one thing that we do want to, or that I want to mention is, no matter who wins in this upcoming election, historically the markets still have performed well under both parties. And so we are not suggesting that we are afraid of one party or another. But it goes back to the importance of having a plan and avoiding the knee-jerk reactions that are going to cause the plan to falter.
Mm-hmm. Yeah, for sure.
So I want to take this opportunity right now to give out our phone number, because if you have any questions about your own portfolio as we go along here, this is the number to call or text 256-937-2010. That's how you can reach out to Cris. Get on their calendar, guys. It's complimentary. If you have questions about, what you're doing for retirement, anything that comes up during our show, certainly give us a call, 256-937-2010. Like I said, you could text the word visit as well. And WGFinancialGroup.com is the website. Remember, this show is always available. Later you can come back and listen to it. Just, wherever it is that you get your podcast, Apple, Spotify, wherever, just search for the name of our show, Rocket City Retirement Show. And we're so glad that you joined us today. So, Cris, I think that a lot of people might be surprised to hear this, but tell our listeners, what is likely to be their largest expense in retirement for their families?
I will get to that in 1 second. I just looked over at my notes and I realized I wanted to say something about last week. So we were talking a week or so ago, we had the big drop in the market. And then last week, Luann, we did the whole show really based on behavioral finance and just kind of like, keep cool. Everything is okay as long as you have a plan, that sort of thing.
Right.
So we have a client text line that we have that's archived, and that way our clients can text us and it gets archived for compliance reasons. And one of the texts that I received last week was from a listener. He's been listening for a long, long time. And he basically texted and he said, "Hey, great message today. This is not confirmation bias, but I figured you would talk about what you did talk about today, which is behavior and, makes, just kind of keep cool, even though everything's kind of going haywire." So I just thought that was a really funny text to get on a Saturday. And, just the feedback that we receive from our internal clients that are really avid listeners to the show. I mean, a lot of times they're repeating things to me and saying them verbatim. And sometimes I can't even remember the way that I said it. And they're like, no, you didn't say it that way. You said it this way. And they'll repeat it to me. So it's just fun. So, all right, so let's move into, what is likely to be one of the largest expenses, if not the largest expense for retirees today. And that would be taxes. Now, you're going to have other expenses, your basic living, your taxes. But one of the larger expenses that you're going to have, if not the largest in some cases, will be taxes. And we at the office, that's one of the areas that we tend to focus on. We're looking at the entire financial plan, and we're always trying to help our clients identify what is really the most tax efficient way in which to pull money out of a portfolio. So what I wanted to do today was kind of talk about a situation where I don't think people think of it like this, but you should. And that's really the purpose of our show. So as listeners know, our show is very radio focused, very educational focused. I'm not trying to get you to buy books. I'm not trying to get you to get free reports. I'm not trying to get you into my tax class or anything like that. You want to come to some of that? That's fine. We can talk about that offline. This radio show is to educate the listener, and we keep it very, very education centered. This is the way you have to think about taxes. Every withdrawal that you pull from an IRA is going to have some element of tax or be subject to some element of tax. Okay. So let's just take for an example here in the state of Alabama. Let's say we've got a 63-year-old. They're taking an IRA withdrawal from the husband's IRA. So we have a 63-year-old couple, and by taking one IRA withdrawal, depending on how much they take, there's a potential for 6 different taxes in this case. So let's assume, again, we've got a couple, they're age 63, and let's just say they pull out $200,000 out of their portfolio. Well, they're subject to federal tax. So that's one tax. They're subject to state tax, Alabama state tax, because they're under the age of 65. If those of you who've listened to the show for a little while remember that last year it was signed into law that the state of Alabama does allow you to pull some out of a retirement account without being state taxed, but you have to be 65 or older in order to make that happen. So in this case, we've got a 63-year-old couple. We're subject to federal tax. We're subject to state tax on the tax return. We're also subject to IRMAA. And because both of them will be 65 in 2 years, we know that Medicare looks back 2 years. So that would be this year if they're 63. So now we've got IRMAA 1 and IRMAA 2. So IRMAA for the husband, IRMAA for the wife. So that's 4 taxes. And then if they're already both collecting Social Security because maybe they retired early, they didn't listen to my show, maybe they didn't come to see me and let me run some analysis for them on why they should wait. So they started collecting early. Now that we pulled this money out, we've got additional taxes on the Social Security. So we've got 2 Social Security taxes because of, husband and wife again. So that's a total of 6 different potential taxes just with one IRA withdrawal. Now that's important because we have to think about this stuff when we're in retirement. I think that we tend to take for granted when we're working. We get up, we make our coffee, we go to work, and everything's run through this payroll cycle. And at the every other week or every month when you're paid, you get your pay stub. The problem is it's just automatically done for us. We don't probably look at it that often. I know that I don't ever look at my pay stub, Luann. I don't. I mean, I own the company. I'm a salaried employee.
Yeah.
But I really never look at my pay stub. Why? Because I know a certain amount goes to my HSA. I know a certain amount goes to my 401k. I know a certain amount goes to federal and state taxes. I just don't look at it because it's automatically generated. Now, there was a day when, back in like the 90s when I was working in manufacturing plants, we were handed a paper check. They walked around. This is before direct deposit became a real big thing. And then you kind of opened it up and you might look at your pay stub. I never look at it now. I don't. So when you get into retirement, you have to pay attention to this stuff. You have to come up with a tax strategy and try to best understand how is the most tax efficient way to pull money out of a portfolio. What I've seen in a number of cases is there's so much forced income coming into the household that you can't control it. So let's take, for an example, we have Social Security and pensions. There ain't a whole lot I can do about that, but that makes the withdrawing from the IRA that much more important because I have a certain amount of forced income coming in. So now I got to be efficient with the stuff that I actually withdraw out. So I think if you're listening to the show today, this is how you have to think about retirement and taxes is like, what is the best way that I can optimize the assets that I have saved throughout my life? And if I have some of that, call it forced income, pension, Social Security, maybe annuitized income, then what's the best way that I can withdraw out of my portfolio? We work with all different types of families, but what we've seen over here in the past few years is we've seen a transition to a higher net worth engineer type family that comes in to see us because they like the fact that we're data driven. They like the fact that when we're building the retirement plan, we're doing that with a Monte Carlo analysis. We're looking at income rates. We're talking about taxes. So for the high net worth listener, if you're listening, today, trying to figure out like, okay, I'm getting close to retirement. I think I need some help. I've done it all my life, but I'm getting into this zone where I don't know that I'm fully comfortable. I'm not sure that I fully understand, or maybe you just don't want to worry about it anymore. Like me, I don't want to worry about it when I retire. I want to have my accounts. I want to have my stuff set up in a way that just generates income and I can go and enjoy retirement and not be thinking about returns all the time. So if you're a high net worth individual right now listening to the show, I do believe you have to start thinking about taxes big time. You're in a different situation than just the average net worth person because you have likely a large IRA, maybe an ESOP plan that is going to be subject to taxes down the road. And we know, because everybody preaches this on the radio, that taxes are set to sunset at the end of 2025. I don't know where they're going to go, but I can tell you by law, they're going to go up. And they're just basically going to revert back to where they were when Obama was in office, but they're going to be adjusted for inflation. So they're going to go up. And that's going to hit most everybody in terms of taxes. So I think, again, if you're a high net worth person listening to the show today, you have to start thinking about, should I Roth convert? And if I should, and I think it's the right thing, when should I start? Okay, when should I actually start doing Roth conversions? Is that when I work, when I retire? When should I start doing that? And if I can figure that out, how much then becomes the really big question. How much do I Roth convert? Do I do the option where I get most of it done in the first few years? Do I stretch it out, stay underneath the IRMAA limits? If I'm Roth converting, do I really need to take Social Security? Should I delay that to leave more room on my tax return? Okay, and if I've got that figured out, then I have to think about, well, how do I pay the taxes? Okay, if I Roth convert, we all know that creates a taxable event. If I Roth convert from a pre-taxed account to a Roth, I've got to pay taxes. So where do I pay them from? Do I take money out of my savings? Do I sell some non-qualified assets? Do I just gross up the IRA and withhold those taxes? I don't know. These are all questions that we have answers for at the office and the types of planning that we do. If you're going to Roth convert, like what bracket should I stay in? I know a lot of people, there's a lot of reading online. You say, okay, well, I'm going to stay in the 22% bracket, maybe the 24. What bracket should I stay in? That's another question. And here comes kind of the ringer for the higher net worth individual, especially if they own a business. It's like, what happens if I go to sell the business? How does that impact my income? How does that impact my IRMAA penalties? How much capital gains am I going to have to take? Am I in the right entity? Because what I've seen in years past in doing financial planning, someone selling a business, they may not be in the right entity that's most favorable for a sale of a business. So I think you have to know these types of things. And Luann, I just believe that, some of the things that we talk about on air today, the taxation, how to pull money out of a portfolio, I believe that has helped our business grow because people, hear the subject matter that we're going over and then they go validate it because that's what everybody does. You go to the doctor and they're like, here's a medication, you got the flu. Next thing you do, you're in the car before you leave the parking lot on Google, looking at the medication and the recommendation. Yeah. But people hear our stuff that we talk about and they take it to Google, they validate it and they're like, oh yeah, they were talking about that in a sense. We can't go into all the detail, right? I mean, we try, but it's nearly impossible, I guess, to go into the level of detail on the air because you'll just lose people and the show will become, boring. And it's like, I can't listen to this. They just talk way over my head. I'm totally lost. And so we try to, introduce you to topics and things that we do at the office and things that we recognize, because there are people that come in the office and they lay their, statements out, they bring all their data with them, and we can see problems right away in some cases because a lot of what we do, it becomes pattern recognition. People are going to work and they're going to retire. And when they retire, they're going to have a certain amount of assets. A certain amount of that's going to be in pre-tax. They're going to have a certain amount of guaranteed income. They're going to have a certain amount of Social Security. So there's a lot of patterns there. And part of my job is being able to do pattern recognition. I've seen this before kind of thing. And I think that's where, they can't see me, but you can see me because we look at each other through Zoom while we're doing this. That's where the gray hair comes from. Yeah.
And your daughter.
Well, and my daughter. That's exactly right.
I'm kidding.
For sure. No, that's for sure. And the plant as well. Yeah, but I guess inside each one of those gray hairs is a lot of experience, right? I mean, you've been in the industry a while. You've seen a lot of stuff. And we talked about it on the radio. Actually, one of my most liked Facebook videos out there was talking about graybeards. And there's value there. There's value in having the young guys like Graham and Richard at the office. Yeah. Then there's also some value in having some of that experience there at the office as well. And I think that's what's helped our firm really attract the level of people that we've attracted, the number of people. And again, we don't put a dollar disclaimer out there. Like we don't say if you got to have more than 500,000 to come in to see us. That's not the way we do it because we have a firm where we feel like everybody deserves a shot and needs help. So, but I can tell you that our net worth has trended higher because of the type of planning that we do and the way that we look at things and the fact that we're pretty data driven. And I believe here in Huntsville, with one of the highest concentrations in PhDs in the entire country, that has, really married well with what we do at the office. And I feel like that's kind of where we're trending.
Yeah. So, all these questions that we are asking ourselves, should I do a Roth conversion? When do I start? How much? All that. Do you guys do a type of analysis when people come to you to ask you these questions? I mean, you kind of have the strategies that you've done with other people, but would you do an analysis for people if they called you?
Yeah, we do. So during our discovery session that everybody calls in, and it's kind of cool they call it a discovery session because that's how we've called it for many, many years now. When someone comes in, individual or family, the first thing we're going to do is kind of talk about the first meeting, what that looks like. When a caller calls in, they usually 99% of the time, they're going to talk to Jen. That's my wife, of course. And she's going to call them back. She's going to be the first person that makes contact with that individual or family. She's going to set the appointment. And when that appointment is actually set, then she emails a list of items that we prefer that you bring. Now, what's crazy, and Graham has talked about this before on the air, our radio listeners come in with all of their documents. We like for you to bring a tax return so we can do a tax analysis. We like for you to bring all your statements, your life insurance information, all of that stuff. And our radio listeners come in and they are highly organized. First of all, they're mostly engineers for the most part. And those engineers will come in, everything binded up and are in a folder and very, very nice and organized. And so you'll bring that in. And then we talk about, just what you want to do in retirement. We talk a lot about your family. There are some things that I ask, every family that I know by the look on their face and some of the feedback that I've received that nobody else asks about this kind of stuff. And the reason we ask about it is because we feel like a family is worth more. There's more to a family than just their dollars, right? So, when someone comes in, there are times when they're trying to literally push the statements across the desk to me. And I'm like, just hold on to them. We'll get to that. But there's some other things that I have to get to first. I have to ask that'll help me understand how you're going to process volatility in retirement, how you're going to be able to handle when the market drops, how much income you need, how you look at just money in general, because, there's a book on it, The Psychology of Money. There is a lot of psychology with money. So I need to ask a lot of questions up front to really start to build that profile of an individual, just because it helps me decide, how I'm going to be able to work with a person. Because let's face it, when people come in, they're coming in to interview us, and we also we want to be able to interview them as well. And that's what makes the meeting, the discovery session, very, very helpful for both parties. It allows both of us to ask a lot of questions. Yeah,
and I think, one of the, and this is fairly obvious, but I think one of the biggest reasons why it's great that the radio listeners are usually so prepared is when you're doing these analyses, you want to be as thorough as you possibly can. And, it's hard for us to make recommendations without all the information. So, I mean, it's definitely a vulnerable thing in some ways to come in and kind of lay out your whole financial picture for someone. But I think it's very necessary in order to make a good recommendation for someone, because we don't just need to see your one Roth IRA account and advise about your whole financial situation based off of that. We need to know about your investments, your income, your taxes, your estate planning, all of those things. And so it is great. And, sitting in with those radio listeners, it just makes our job much easier and makes us be able to do a much more thorough job for them when they come back to see all of their options.
Yeah, I think, mentioning radio listeners, the TV listeners have now started to come in very, very organized, because now we've been on the TV for so long now that they're starting to realize, hey, they're a real company. They're not going anywhere. And then all of a sudden they have 20 or so episodes they're now watching, and they've started to, I guess some of it's a trust thing, right? I mean, to bring yourself to that position and get vulnerable, there is an element of trust there. But I will say this about what Graham said. It does help us. But in reality, if we don't have enough information, enough data, we can't give you the output that you're desiring. And it's the same sort of thing when you look at like NASA. They can't build rockets if they only have part of the plan, right? I mean, They have to have the entire blueprint, the data, and all the data helps us be able to, build that blueprint and provide that outcome that clients are looking for. So, Luann, this first 30 minutes has kind of flown by. So
yes, it has.
We've kind of gone through the first half of the show. So if you're listening to this and you're catching the 30-minute version, you can hop out to Apple Podcast or Spotify and catch the entire version of that. We're going to get into some other tax stuff on the back side of this show. So we look forward to that. If you want to give us a call to set up your discovery session, please feel free to do so. 256-937-2010. Again, we don't do gimmicks and try to buy come get a book or come get a free report. What we want you to do is, if you want to have financial planning done to help you and your family, give us a call, 256-937-2010.
Navigating uncertain times in the volatile market? Don't make impulsive decisions. WG Financial Group is here to help you plan, retire, play. Call now at 256-937-2010. That's 256-937-2010 for advice you can count on.
Quarters, just 25 cents. That's hardly anything, right? But Cris Wallace and his team at WG Financial see quarters a little differently. A quarter is a lot when it's a quarter of your retirement savings. Now, do you want to pay 25% or more in taxes during your retirement? Well, Cris can create a plan to help address that. Now, if the only time you think about taxes is when you file them, you don't have a tax strategy. But it's not too late to get one with the help from Cris Wallace. So act now to make sure you're not paying a quarter, dime, or even a penny more than you should. Call Cris Wallace and his team at WG Financial at 256-937-2010 to schedule your personalized tax strategy session. A quarter saved is a quarter earned. Call 256-937-2010 now. That's 256-937-2010. Investment advisory services made available through AE Wealth Management, LLC, a registered investment advisor. Firm may not give tax advice.
Have I saved enough? Will my retirement last? If these are some of the questions you may have, it may be a good time to set up a visit with Cris Wallace. Just text the word VISIT to 256-937-2010 to schedule a meeting today.
And thanks so much for being here today. You're listening to the Rocket City Retirement Show. I'm Lou Ann Fulmer here with Cris Wallace, Richard Constantine, and Graham Bauer. So I have a question for you, Richard. Give us some ways to avoid these IRMAA taxes that Cris was talking about and, just lower marketplace insurance costs if you are a higher earner and you happen to retire early.
Yeah, absolutely, Lou Ann. And, first off, we can't give away all of the secret information, but, we will. One of the things that especially these higher net worth clients can do that have the ability to retire early is to start making a plan when they're between the ages of really 59 to 62. Because as Cris alluded to previously, IRMAA limits look back on 2 years prior's income. And they also will stick to you for 2 years. So let's say at your age 64, you haven't turned on Social Security yet, and you want to live off of, $30,000 a month on a pre-tax level, right? So that after taxes, that's going to be about $20,000 a month. The IRMAA penalty for that is going to carry forward even when you're 65 and 66. And so if we can start having a plan before your age of 63, that's when we can really get flexible and try to eliminate your taxes as much as possible.
Mm-hmm.
Yeah, I think sometimes, honestly, if you go into those IRMAA limits, sometimes it is what it is. Maybe it's part of the plan, right? I mean, sometimes that going in. So let's say that you've got a high net worth individual, and the best opportunity for them to get their large pre-taxed IRA converted over is to go ahead and hit those IRMAA limits. And again, you're only there for 2 years. So if you're running through a big, heavy Roth conversion, you just kind of go into it with the acceptance of, hey, I'm probably going to bust through these IRMAA brackets and I'll be there for a couple of years. And you're just okay with that because you're looking at the long-term effect of a conversion. Is a conversion better now long-term and to kind of eat the IRMAA taxes early? Some of that is you just kind of know that going in.
Oh, yeah, absolutely. But, the one thing that I was really more going at was, there's no reason that you should just be going blind into it and seeing what will kind of shake out at the end. There are, like as Cris mentioned, we do recommend doing Roth conversions up to a certain level. And so if that is part of the plan and everyone's on the same page of that, then that completely makes sense. And by doing those Roth conversions early, you're going to have zero potential RMDs in the future if you convert the whole balance. and therefore you're not really going to have any IRMAA fluctuations further down the road. But if you're just going into it without really knowing why you're going into it, then that's the areas that we want to be able to help out with.
So basically what you're saying is planning will help you avoid surprises.
Indeed.
Yeah.
But then on the flip side, it's you have to plan for the unexpected as well, right?
Mm-hmm. Mm-hmm.
Yeah.
For sure.
Plan for the worst, hope for the best. That's what we kind of say. Kind of our
Yep,
motto.
that's
One of
right.
our mottos here on your show, Chris. So, we know we've been talking about this a lot, that, at the end of 2025, that Tax Cuts and Jobs Act is going to retire or sunset, whatever you want to say. So tell us, what are some of the tax risks that families might be facing moving forward, Chris? What do you see in your crystal ball?
Well, I can tell you that, like I said earlier, it is unfortunate. I mean, taxes are pretty much going to go up for everybody. And I know politicians run on, I'm not raising taxes on the middle class, but that's bogus. I mean, it really is. I mean, if you just look at the 24 bracket right now, the current 24, the 24 is going to become the 28 and 33. So some of that 24 top end 24 income today is going to crawl up into that 33 bracket. Mm-hmm. So you're telling me right now on the 24 bracket that you're not going to see an increase, and that's just bogus. You're going to see it. It's going to go up on you. So you've got that part of it you got to worry about. So you've got higher income taxes. And then the thing that I find that I don't think enough people are talking about this is the estate tax limit. Now, currently it's 13 million and some change. I'd have to actually look up exactly what the number is. But between a married couple, it's about 27 million of total exemption that you'll have. So you got a pretty high threshold there from an estate tax perspective. Now, what's going to happen at the end of 2025 if nothing is done? That single individual estate tax is going to go back down to just slightly under $1 million. I'm sorry, slightly under $1 million. I wish it was under $1 million. So does the government. It's going to go slightly below $7 million. So you think about that and you say, well, $7 million, that's still a lot of money. It's really not, because that's your entire estate. So if you take into account your house and what's known as your gross estate, a 7 million number is pretty easy to get to. So if your house is worth, $750,000 today, or maybe $1 million, and you've got, let's just say you've got $2 million in retirement savings, it won't take long to eclipse the 7 million. Now, with a married couple, you have the portability. So you got really like 14. But I think what a lot of people aren't thinking about is, for me, I think this is easy for the government to go after, because it's easier to tax a dead person than a living person. I mean, let's just be honest, right?
They're not going to fight back.
They can't vote. Well, sometimes they can, but we won't go there.
Well, that's true.
Yeah,
we won't go into that.
Yeah. So, but here's kind of the deal that I don't think a lot of people think about. Okay, if I'm at let's just call it a net worth of $4 million today, your net worth, if you're in your early 60s, is probably going to double at least twice as you age. Mm-hmm. So if it's worth 3 today, in say 10 years, it's now 6. And then, in another 10 years, it's now 12. Guess what? You're over that 7 and you're creeping up on that 14. So I think that there's got to be at least some conversation around the estate tax, because for the amount over the estate tax limit, it's about a 45% tax on those assets. And the taxes are due 9 months after death. Mm-hmm. So there's not a lot of wiggle room there. So there is some planning that can be done there. And by the way, just in case anybody's out there listening to the show going, oh, you know what, I'm just going to Roth convert everything. Guess what? Roth IRA money is still counted in the gross estate. Your kids won't have to pay any income tax on it, but it is countable in the gross estate asset. So again, there are some types of planning that you can do out there to kind of help with that. And I'm not one of these, in talking about this, I'm not one of these negative Nellies that are like, oh, tax rates are going way up. It's just not the way that we do the show here. We keep it very education, non-fear based. I don't believe, tax rates are going back to 90+% like they were just after World War II. Mm-hmm. But I do think they're going to go up. We just don't know how much. And there's all kind of different opinions. There's the Wharton school out there that's kind of projected some stuff, towards 10 years down the road, tax rates have got to double or whatever it is, but it might. It very well might. But the truth is, I've been hearing taxes are going to go up for a long part of my life, and here we are. But I do feel with the amount of debt and the amount of spending that the government currently does, because they spend money like drunken sailors, I definitely think taxes probably have to go up in the future.
256-937-2010. That's the way to reach out to Chris. Go in for that complimentary discovery visit. If you have any questions about taxes, like we're talking about, and you want to, go in and visit about your own tax strategy, that's what Chris and his team do. That's one of the things they talk about as they're going through the Rite Retirement process is your taxes, tax strategies, estate planning, okay, all of that. And then, of course, income and investing and all those points that are covered in their plan. And, like Graham just said, you have to have a plan, plan for everything, plan for the worst. But then, of course, we're going to hope for the best. Call or you can text the word visit 256-937-2010. That's the number. Check us out on Facebook too, because anything that we discuss on our show, if Chris needs to, make an addendum to it or make any updates, on what's going on throughout the week, WG Financial Group 256. And then head to the website too, WG Financial Group, find out more about the team. And this show is available on, Apple Podcasts, Spotify, anywhere that you get your podcasts. Just look for the name of our show, the Rocket City Retirement Show. We're so happy to have you along with us. I'm Luann Fulmer here with Cris Wallace, who is a certified financial planner and financial advisor, and also joining us, Graham Bauer, financial advisor at WG Financial Group, as well as certified financial planner and financial advisor Richard Constantine. So we've talked about this before, Chris, but I want to go over it again. Just the importance of Social Security and how it relates to tax planning and retirement.
Yeah, I can't stress this enough for people. It's really unfortunate. I see some really good decisions out there. I've seen some really bad decisions, but I can say that a lot of people that have come in to see us as of late, they're on that train of, look, I'm willing to wait on Social Security. I'm actually thinking about doing this. And so that you can tell they've been listening to the show and they're fans of the show and they're kind of in line with our thinking. The first thing we got to remember right out of the gate, worst case scenario, we know that Social Security is taxed more favorable right out of the gate. We know that. Only 85% of it can be taxed. Like when you take an IRA distribution, 100% of that is subject to income tax. So we know right out of the gate, Social Security is more tax favorable. And we know, because we've talked about this show on the show a lot, is that if you just have Social Security and that's it, nothing else, maybe you got $55,000 between two socials coming in as income, you're in a zero federal and a zero state bracket. So it is beneficial to wait and maybe spend down some qualified assets, in our opinion, in order to let your Social Security grow, because there are delayed retirement credits that you are earning as you age, and those are set and they're guaranteed, and your Social Security amounts are actually going to grow. And when you just have Social Security, then you also create a little bit of wiggle room. If you just have Social Security, you create a little bit of wiggle room where you can pull out of an IRA without any taxes at all. Or you can use that quote unquote wiggle room to do some Roth conversions. So Social Security is a really big part of the planning tool. It was originally designed to replace about 40% of income. There's a lot of people nowadays that use it for a lot more. But at our office, we're running scenarios. We're looking at, okay, what's the best way to take it, but also what's the best way to take it in conjunction with doing your investment tax planning as well.
Okay.
Well, and Chris, one of the things you mentioned is that a benefit of delaying your Social Security is that you have more wiggle room to either Roth convert or to pull out the qualified money, as you mentioned, to live off of. There's a lot more avenues that you can get to having the same amount of income coming in versus just pigeonholing yourself into one specific plan without really thinking about it.
Yeah, that's a good point that you just made, and the way that you said it made me think, okay, well, if you have more Social Security income, then it's less out of an IRA you have to pull if you have only pre-tax assets. If you have less Social Security income, and I'm trying to remember what I just said because I'm thinking about this at the same time I'm talking about it. So basically, if you have less Social Security income, you have to pull more out of an IRA.
Right.
But if you have more Social Security income, then you just pull less out of an IRA. It's taxed. Again, that's more tax efficient than pulling the larger chunk out of the IRA, which again can subject you to higher taxation depending on if you're under the age of 65 here in Alabama. You may have state tax. You may also encounter IRMAA limits. There's lots of things to think about there. But using Social Security kind of, I would say almost like a base and kind of plan off of and around to some degree Social Security, I think is really, really important.
Richard, as we're talking about these Roth conversions, is this something that you would recommend someone do while they're working, or should it just be focused for retirement?
And that's a great question, Luann. And it really goes back to the client's net worth size. So, for example, there are two different families that I'm working with now. We project them to have sizable pre-tax accounts. They already have sizable accounts now, and we project them to keep on growing throughout their life. So what we're doing is the two different clients. We've come to an agreement on different levels of income tax brackets that they are comfortable going to. But we are trying to convert as much as we can with staying inside those income tax brackets, just so, one, they have the flexibility to access funds earlier in their retirement if needed. The idea of doing these Roth conversions is to not touch it, but if something drastic happened, there is some money available that wouldn't be taxed. But really the benefit is, so when they reach age 75, their RMDs are not going to be through the roof.
Mm-hmm.
And so that is one of the reasons why we are, even while they are still working, we are going to go and proceed with Roth converting while we still know the tax laws for this year and next year.
Yeah. And a couple of things just to kind of keep in mind. So I want to kind of give a visual of what you're talking about, Richard. When we're talking about staying in the tax brackets, let's just use the 10, the 12, 22, and 24. Think of them like glasses that you would drink out of, and you're filling up the glass with water. And when the 10 glass is full, it spills over into the 24. So not all of it spills over into the 12. I'm sorry. Okay. So the 10 spills over into the 12. So not all of the glass is taxed at 12, only the part that spills over into the 12. So you fill up the 12, and the 12 then spills over into the 22. And at that point, not everything's taxed at 22. You have only the portion that spilled into the 22 taxed at 22, but you have the 10 and the 12 all the way full. And then you have what's called kind of your average or your effective tax rate that is the average across all of that. So as Richard's talking about staying in those brackets, that's essentially what he's talking about. Now, we would also recommend, as we're looking at this, as he does, and I do, Graham does as well, is that you leave a little bit of buffer room. You don't want to go all the way to the top because interest rates are pretty high. If you have a big chunk of money in savings, then you want to leave yourself some room in case there's some interest income that you didn't account for that all of a sudden a 1099 shows up and it doesn't push you over into that next bracket. The other thing that I'll mention here is that if you do a Roth conversion below the age of 59 and a half, you better have the cash to pay the taxes because you cannot withhold it from the IRA. If you withhold it from the IRA below the age of 59 and a half, it will go as a 10% tax penalty. That's really, really important for a lot of people to know and understand who are trying to do stuff on their own and they're out there. This is one of those gotchas where like, oh, listen to Chris's show and we can start Roth converting and I'm 55 and I'm going to withhold the taxes from the IRA. Well, good luck. You do that, you're going to get hit with a 10% penalty for doing that.
Good information. Glad you brought that up. Yeah, that's very important. Yeah, in fact, don't do anything until, you get some financial advice from professionals because, we don't want you making a mistake and coming up with a penalty for sure.
I'll say something else. You're talking about mistakes.
Yeah.
Here's a good one for you. So I had somebody come in yesterday. Today's Tuesday. We recorded on Tuesday. This guy came in on Monday, and he was telling me he did a backdoor Roth IRA contribution. So a backdoor Roth IRA contribution is usually reserved for a high net worth individual that cannot make contributions to a normal Roth IRA. So what they do is they put it into a traditional IRA and then they convert it to a Roth because you can convert at pretty much any age. And as I mentioned, if you're below 59 and a half, you better be able to pay the taxes. So after doing a discovery session with this individual, and he told me like 2 or 3 times before I got to his assets that he did a backdoor Roth and that a firm had told him to do a backdoor Roth. And I was like, okay. And then once I got through my discovery session, I looked at his modified adjusted gross income, and I was thinking, why did you do a backdoor Roth IRA? Because you're under the modified adjusted gross income limit to where you could just make a normal Roth IRA contribution. And it wasn't like he was trying to do more. He actually just did the 7,500 limit. And I'm just wondering why you went to all that trouble.
Yeah.
And he's like, I don't know. That's just what they told me to do. And I felt like he was getting a little bit frustrated. And I wasn't asking in a manner, like, hey, this is dumb. Why'd you do this? It was like, help me understand the logic behind why, well, first of all, who told you to do this?
Right.
Because you just could have done a straight Roth IRA contribution. We even pulled up the limits, and and that's the thing about when you come into the office about being vulnerable. We're not coming in to judge anybody, but we do want to ask questions. I think that we need to ask questions as advisors. But I could tell this gentleman, he got a little bit frustrated. But I was trying to get to the understanding of why another advisory firm told him to do that. And we see stuff like this all the time. And it's like, this doesn't make any sense.
Right. So, all right, as we're talking about these Roth conversions, Chris did mention the Social Security income, but here's the deal. A lot of our listeners have pensions. Okay. So, Richard, why don't you talk about that? Just the value of a pension plan, not only, as guaranteed income, but also in dollars. What's a pension worth in dollars?
That's a great question. And I realized recently that, I had never actually thought of it in that kind of manner before. We had a client come in, and the wife was a teacher. And she was set to begin receiving roughly $2,200 per month. And she was, in a way, feeling bad that she had not saved more for retirement. And so, but if you actually look at it from what the value of that $2,200 a month pension is, as we have talked about previously on the show, the 4% rule is not necessarily the best metric, but it is a decent metric to understand what you can pull off from the portfolio. So we're going to use that for this example. Okay. And so the $2,200 per month is $26,400 per year. And so then you divide that by 0.04%, which is what we would recommend, or what the 4% rule says you can pull off a portfolio without a risk. And so that pension is essentially the equivalent of having $660,000 inside of an investment account.
What? Oh my gosh.
It is. And all that to say is, pensions are an incredible tool, and they really should be viewed as an asset. It is part of your whole plan. It is not just, I feel like people sometimes minimize the value of them. They feel really good about their 401k hitting $1 million, but they don't necessarily feel as great of their pension equaling an equivalent amount.
Yeah, pensions are great. I mean, those that are lucky enough, blessed enough, fortunate enough to have them, man, what a big benefit that is to have in retirement. So,
Chris, my dad wanted my sister to teach kindergarten. She majored in early childhood development, and she just wanted to do, preschool. That's what that's what her major was. And so she was going to have her own daycare in her home. But he was like, man, you should work with just the 5-year-olds and go work for the, state, in essence. And then that way you'll get a pension and everything. And oh my gosh, she was so bound and determined to not do it. And I know now, I look at she and her husband now, they've both been sort of self-employed their whole lives. And here they are in retirement. They're in their 70s. And I can guarantee you Patty wishes that she had some type of a pension. So,
they're big time.
He tried.
Big time helpful.
Yeah.
No, they are incredibly valuable. And, there is just also another level of certainty and reassurance that the money is going to come in without a doubt. And, for this example, I mean, her pension was what really tipped the scale to where we felt comfortable giving them the green light to call it quits for everybody.
Mm-hmm.
Yeah, and I'll give a quick shout out to teachers, because I think teachers specifically a lot of times feel really behind in retirement, because obviously, as we know, teacher pay is not one of the highest paying jobs in the U.S. There are other good benefits, but I think that pension is really, really powerful. We'll see a lot of teachers who, I would say generally, at the middle and high school level, tend to be maybe a little bit more behind on retirement, just because they don't have as much income coming in as some people who work in the private sector. But a lot of times, they end up still being able to live a pretty comfortable lifestyle in retirement because of those pensions that they have if they've worked for a long time. So, I mean, there's, like you said, Richard, and you said, Chris, there's been some times where people have come in and it's been like, this would have been pretty tight without the pension coming in. It would have been like this is a bit of a dire situation, but because of that guaranteed income that we know is always going to be there, it just allows them to feel so much better in retirement, to have that income coming in, and you still want to shoot to oversave. It shouldn't be your goal if you have a pension to undersave, but sometimes it can make up for a little bit of undersaving on the back end.
Mm-hmm.
Yeah, one thing that I found out recently, actually, I think it was in that meeting as well, the Robert Trent Jones Golf Trail, which is, one of the, I might be biased being from Alabama, but, it's one of the best public series of golf courses in the country, is actually owned by the Teachers Retirement Plan of Alabama. Really? And so that's part of what is funding the pension plans that are going out to our teachers in Alabama. So I decided to go play Robert Trent Jones course this weekend solely based off of that. So I felt like I was contributing to our teachers.
There you go. I love that. Very cool. Very cool.
Brownie points right here, Richard. Trying to get brownie points with all of our teachers out there, right?
I got to do what I got to do to get the extra credit, right?
Yes, star student over here.
No pun intended, extra credit, right?
Well, Chris, do you want me to just ask you this last question? Probably
Sure.
Don't have a whole lot of time for it, but we've been talking about Roth conversion. So should everybody consider this?
If it's not everybody, it should be a lot of bodies. So
Yeah.
I think Roth conversions with taxes where they are today should be a part of the financial plan. It should be a conversation. Again, we run into people just not wanting to pay the tax today. The long-term savings is there more often than not. I would say the younger you are, the more, advantageous it would be. And I think the other thing that you have to think about here, and I'll kind of end the show on this, but if you think about where you are in the brackets today, that's fine. Consider that, talk about it, figure out where you think you're going to be. You have to look long term. What's your RMD going to be? Is that going to push you up in the tax brackets? What if tax brackets go up? But here's the kicker: if one of y'all dies, you're going in the single filer bracket, and that is where you're going to feel it, because more than likely, if you have a large IRA, now you're in the single filer bracket, and you're having to take a big RMD, kicking you up in the tax brackets, kicking you up in the IRMAA brackets. IRMAA's withheld from your Social Security, so now your Social Security is less. Your spouse has a potential to draw less income because of that if they go in when one of y'all goes in a single filer bracket, assuming that one of you dies first, which is usually the more common way that it happens. So those are all considerations that need to be discussed, and that's the type of planning and the discussions that we have at the office. You can come in and sit down with myself. You can sit down with Richard. Both of us are certified financial planner professionals and financial advisors, so we're happy to go through that in what we call a discovery session. You can do that by giving us a call at 256-937-2010. Again, the number is 256-937-2010. Hope everybody has an awesome and blessed week, and remember to serve every person in every situation with a servant heart.
Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.
Investment advisory products and services made available through AE Wealth Management, LLC, a registered investment advisor. Insurance products are offered through the insurance business WG Insurance Services. WG Financial Group is an investment advisory practice that offers products and services through AE Wealth Management, LLC, a registered investment advisor. AEWM does not offer insurance products. Insurance products offered by WG Insurance Services are not subject to investment advisory requirements. AEWM and WG Insurance Services are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. WG Financial Group is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by WG Financial Group. This radio show is a paid placement.